Hello and welcome to a fresh new edition of Bazaar Morning Call. I am Prashant and with me are Sonia Shenoy and Nigel D'Souza. Guys, hi. Good morning.
Good morning.
We start this morning with pretty decent global cues. The breather in the global equity market continues. The S&P 500 is on a gaining trot, I would say, for 3 days in a row. I mean, despite last night's 0.25% cut, I would count that as flat. The story with the overnight was not the 0.25% cut, but the fact that the S&P recovered 1.6% from the lows. So you are basically coming up this morning reacting to the S&P, which is up almost 3%. You're reacting to 3% on the US market side. And why is this important? In the face of negative news flow, equities overnight ended flat. You know, there was the ISM services index, which was strong. Manufacturing was weak, but what's important for the US is services, and that came in strong. There was hawkish Fed commentary from usually dovish Fed members, and we'll talk more about that, which pushed back against this entire pivot thesis. And there has been a large cut in OPEC production, which has pushed up oil prices. In the face of all of it, US equities, by close, they were down 2% at one point, more than 2%. They ended absolutely flat, and I would rate that as a pretty good outcome. On the back of all of it, this morning, the SGX is indicating from the last close, yesterday was a holiday, almost 120, 130 odd point higher start. So that's basically the rate on your screen, 17,435. Guys, hi, good morning.
Hi, morning, Prashant. And let me also welcome Nigel on board. From now on, Nigel's going to be with us on Bazaar and going to, partake in all the madness, all the chaos. So, Nigel, welcome.
Well, thanks a lot for that, Sonia, as well
Welcome
as
on board,
Prashant. It's a childhood dream, right, in our profession to open market or open the batting for the team. And irrespective of where you bat, you're just giving your best. But
absolutely.
I'm very happy to be here and looking forward to participating in the party, as you said it.
Okay, the party goes on, right? I feel that perhaps in the market as well, the party could continue for the Indian market. Just look at the data, right? As Prashant was also pointing out, now global markets have stabilized a tad bit. FIIs and DIIs bought in the cash markets on Tuesday. So FIIs bought about 1,300 crores, DIIs bought 950 crores. And the Nifty has held on firmly to the 200-day moving average of around 16,870. Now, in fact, that 17,200 mark that we were knocking on the doors of and we slipped from in the last many weeks, that has been conquered as well on the upside. So for now, looks like this uptrend will continue. There was a sharp rally that we saw in the US markets on Tuesday. There was a big intraday recovery on Wednesday in the Dow. And, the labor market data was very strong. 208,000 jobs added in private payrolls. The ISM services index showed a solid growth in the US. So I think our markets fall less when global markets fall and they rise more when global markets are stable. Perhaps that could be the way forward today.
It looks like it. When markets and prices do one thing and data is telling you another, I think you should follow prices. If you're trading especially, and I think that could be the case today as well. I actually went to sleep looking at the market down 2%, a little over 2%, and we woke up with a 0.25% cut. That's big recovery, which I think could mean that this global bounce could continue. That's point number one. By the way, on the Nifty, and this happened on the last trading session, that is Tuesday, has almost filled an important gap, which was made on the 26th of September. That was between 17,196 to 17,291. Intraday, the market crossed 17,300. We ended slightly under 17,291, but that gap has been almost filled. You can look at resistance. There is a resistance at about 17,350, 17,400, which most would focus on. But to my mind, the bigger resistance from here, if the market continues its upward journey, supported by fairly decent global cues, given what we had overnight, is going to be that trend line. The trend line which is falling from the all-time high of October last year. And on that trend line, the level to watch is 17,650. It is some distance away. It is almost, 350 odd points away. That is a big, meaningful resistance which you got to set your sights on. The impulse remains to try and buy the dip. I think there is no change in that. Banks and financials remain the strongest corner. Look at, the quarterly updates from bank after bank. The latest, of course, is Bajaj Finance, AU Bank, and many others. Loan growth especially is firing on all cylinders. And I think banks remain very, very strong. The big risk squarely comes from any wild moves. And we've had more than our share of wild moves in global equities, global markets, both in rates, which is the bond market, and equities as well. What could be the risk? The risk was data coming in much stronger than expected and kind of Fed pressing on with rate increases. But to be fair, excluding housing data from the US indicates that economy is just about fine. I mean, it's not like sort of firing on all cylinders. It's not collapsing. It's just fine, which kind of maintains a status quo and at the margin gives the hope that if this data starts to soften a little bit, the Fed could take its foot off the pedal. And in that context, tomorrow's jobs number becomes very important. I think it's the most important number before the November FOMC. Watch oil prices. And this is important for India because what has happened? OPEC has announced the most significant cut in production since pre-COVID levels. The US has stopped releasing oil from its strategic petroleum reserves and crude is inching up. We're at, I think, at about 93.5. But if it crosses 96, you basically would end a 4-month downward sloping channel. You basically would come out of, the level to watch is 96. You essentially would have an impulse to buy oil at the 96 or beyond the 96 kind of levels. And given the latest numbers that we have, the exports data, I mean, even the non-oil, gems and jewelry data, you need help from lower oil prices. And that, I think, is the only dampener, not a dampener right now, but something you need to watch out for, which could give us pause for thought. So that's where we're at. Nigel, what are you watching?
Well, we would have been happier. Actually, we had a trading session yesterday. I'm sure it was a happy Dashera, but the cues last morning was much better. That's the way I would put it. But the data points as well that did come in post Tuesday's rally, well, it was fairly good. The institutions were buyers, and that's the first time both of them were on the buy side all the way in the last 1 month or so. And the FI net buy number, that was the best that we got in the last couple of weeks. So the institutional numbers look pretty good. On the bulls wish list would be either the FI sell less or they buy at least. That would be pretty good news. The F&O side of things, well, we have a live indicator. That's the premium on the Nifty. Well, that expanded in Tuesday's trading session, telling you there was some long addition. And that's precisely what the FIs did. Remember, they were net short on the index. They continue to remain net short on the index, but there was massive short covering, 30,000 short contracts getting covered out, and there was some mild long addition as well. So in terms of them being net short, they're at around 81% of their position still on the short side, though that's come down from around that 87% odd. They were short covering both on the Nifty as well as the Nifty Bank because the open interest was down 5 to around 8%. The biggest positive, though, for me is the writing of puts. Yes, on Tuesday, they wrote close to around 60,000 put contracts. And the most active strike was the 17,200 put, which the premium was in that vicinity of around 60 to around 70 rupees. So that's heartening to see. How do you approach trade today? Well, the SGX Nifty is suggesting a bit of a gap up. You need to compare the SGX Nifty with the Nifty futures. So that's roughly around 130, 140 points gap up. Now, we're going to be starting closer to around the congestion zone. That's with the 20 DMA and the 50 DMA. So the number should come up for you. Resistance zone will be at around 17,450 to around 17,500. That's because of the 20 and the 50 DMA. On the downside, though, since the 17,200 puts saw a fair bit of addition, I think the 17,150, 17,200, that'll be a first level of support. How do you approach trade, though? Maybe if you have a long position, either you're sitting 100, 200, 300, 400 points of gains. So take some money off the table if you get this gap up of around 140 odd. And re-entering, that could be a prudent strategy at lower levels. And I think there will be an intraday dip today. It's also weekly expiry, so things will be a little bit more volatile. Sonia, what else?
And a little bit more exciting, right? I mean, it looks like the market base has moved to that 17,200 level because we had come off from that level a few times and now we conquered it. Yes. So let's see, the US futures are also indicating a start in the green. But there are so many events to watch and, of course, crucial from a market standpoint. One is the September jobs report that comes out tomorrow, and it will be important to see. So far, the labor market data, the ISM data has been solid. Let's see how this one pans out. But for us, earnings season begins full-fledged next week. We kickstart with TCS on Monday. There's Wipro and HCL Tech on Wednesday. Infosys and Mindtree on Thursday, followed by Bajaj Auto and HDFC Bank. So plenty of market-specific, cues, data points is what you're going to get. But purely for today, the SGX Nifty, the adjusted SGX Nifty indicating that the start will be well in the green. Lots of opinion coming through as we kickstart Bazaar this morning. First up, we have Hiren Ved of Alchemy Capital who says the Indian market has been held back because of challenging global macros like high inflation, record energy prices and slower growth. But the undercurrents in the Indian market are strong. Given this resilience, if things turn around globally, he believes our market could break out into a new high very soon.
Well, let's get you some money market views now. This is Kunal Sudani of Shin and Bank, who says that the U.S. economic data surpasses expectations. The focus returns to non-farm payrolls that we were talking about. Risk-off flows returned amid tensions between Europe and Russia. The dollar index finds support at 110.2 levels. For the USD INR, 81.25 acts as a support, while 81.75 is a resistance.
All right, and on the bonds, Dhaval Dalal of Edelweiss says that bond prices rallied smartly on Tuesday despite hawkish comments from the US Fed and an uptick in crude oil prices. Expect prices to give up some of their gains today amidst higher US Treasury yields and some clarity on index inclusion. The 10-year bond yield is expected to trade in a range of 7.35 to 7.45% in the near term.
Well, we have a lot of stock-specific action to track today, and we'll get to that in just a bit in our top 10 segment. We're looking at Zee Entertainment, you have Bajaj Finance, RBL Bank, AU Small Finance Bank, Indiglobe Aviation, SpiceJet, ONGC, as well as Oil India. Now, those are on our radar on the back of positive news flow. We also have Godrej Consumer and IEX. They are stocks that are likely to open up in the red.
All right, Mark Matthews of Bank Julius Baer and companies joining us now to take some questions. Mark, great to have you with us here. Thank you very much. You know, we had a bunch of what could be construed as hindrances. Data which was strong, which in normal times is good news, but you don't want strong data. You want moderately, just about right, not too hot, not too cold data. But the ISM services number overnight was strong. We had some hawkish Fed commentary, and we had that OPEC cut. But despite all of that, I mean, equities have marched on. Absolutely flat close overnight. Do you think this bodes well for the continuation of this relief rally, Mark?
Prashant, by the way, the futures are up 0.5% as of now. So, yes, I think it does. The market had every reason to go down yesterday. It did go down, but just a little tiny bit. So we're still up about 5.3%, if memory serves me right, for October so far. I think it's telling you something. I'm not quite sure what, but it's telling you that the market is willing to look through the hawkish commentary that just a couple of weeks ago would have sent it down percentage points. And, you know, your Bostic said 4.5% on the Fed funds by the end of this year. And Mary Daly still talking very tough. Inflation is high. We're not going to cut. But for some reason, the market's looking through that.
The market is willing to look through hawkish commentary. Is it also telling you that perhaps the worst of the bear phase across global markets is now behind us, Mark?
Yes, I think so. I mean, I wish I'd predicted this huge bear market at the beginning of this year, and I did not because I didn't realize how hawkish the Fed was going to be. In retrospect, back in January, the signals that they were doing a 180-degree turn, we should have paid far more attention to those. But now the market is down around 20% so far this year. I think we are putting in a bottom. October historically is the month where major market bottoms occur more than any other month. And even if we get a recession, I think it'll be a mild one because the labor market is still so strong. There's still 1.7 jobs available for every one unemployed person looking for work. And so 20% decline in the S&P is really about what you usually see when you have mild recessions. And so either we're going to have a mild recession or we won't have a recession, whichever it is. Yes, I think we're putting in a bottom here.
You know, Mark, our viewers will be quite happy actually to hear what you're saying, because the worst of the bear market may be behind us. And also you're saying that the global participants are prepared to look through this hawkish Fed. You had a couple of commentators overnight, Prashant, I'm sure you tracked that closely, and they sounded rather hawkish. They said our core focus is going to be on inflation, and we're just starting off out there. So the domestic bulls out here as well will be pretty happy to hear that.
You know, in the US, guys, the S&P is just about come back above its, it fell below June lows. I think we're right there in June lows, right? Here, the low was what, 15,200, right?
Yes.
Yeah.
And we're at 17.
10% away from there.
It's been incredible.
I think it's also because, you know, our own corporate profitability to GDP ratio has gone up so much, right? We were discussing it. You spoke about Bajaj Finance.
Yeah.
All the business updates that came in the last 7 days have indicated that corporate profitability
chalk and
has
cheese,
improved.
absolutely.
Yeah.
All right, let's get back to that conversation with Mark. Mark, you know, we'll get to the equity markets, but what about the other asset classes? The dollar index, well, it moved to around the 114 very briskly. It pulled back a little bit. I recall when we chatted last, we were talking about 110, 111. So what's the outlook on that one? Because that's one of the key points that, you know, for our Indian markets. And Brent crude getting a little uncomfortable, right? At around $94 per barrel. Outlook out there.
Nigel, you're absolutely right. The dollar is key. And I was interested to see the cover this week for Bloomberg Businessweek's magazine is the dollar can't stop, won't stop. And you can Google it. You'll see a big cartoon of the dollar going up and up. And there is something called the magazine cover index, which is basically a indicator that when something gets on the front page of a major magazine like that, you do the opposite because everybody already knows. So I think the dollar is actually peaking around here, not necessarily right now, but if I look back at the rolling 12-month rate of change in the dollar over the last 50 years, only 3 times did it exceed the 20% level that it's at currently, which were in 1985, a few months before the Plaza Accord, and again, the global financial crisis, and then when China devalued the renminbi in 2015. And my point would be that, yes, in those times, it did go higher on a 12-month rolling basis. It did get as high as, I think, about 25%. But in all 3 instances, it then fell very quickly thereafter. And I can't really say what it might be that causes the dollar to go down this time. But my hunch is that history doesn't repeat itself, but it does rhyme, and it will be going down in the months ahead. As for the oil price, $100 a barrel is possible given the production cuts from OPEC last night, and certainly makes one less confident about headline inflation going down, because the major reason for the headline inflation going down was the oil price.
Mark, the other one is China, right? Which many are. Middle of this month, we've got that big conference in China. And if there is significant policy change, and I don't know who, Morgan Stanley or one of the other sell-side research houses said if China changes its reopening, changes its zero COVID policy even a little bit, I mean, oil would be in serious short supply. I think we heard that from OPEC as well. So from an Indian market perspective, oil is critical, crucial. Any thoughts, Mark?
Firstly, I don't think if they open a little bit, that will mean the oil price goes up. They'd have to open a lot. And I do not think they will open a lot. It's anybody's guess. But I think that, the bond market will tell us, because when bond yields in China start rising, that'll be a signal that better times are coming for the economy, or maybe stimulus is coming. And they're simply not going up. Maybe that's because nobody knows yet what's going to come out of the party Congress, but and nobody does actually. So I think we just have to wait and see. But if I had to choose between opening up or not, I would say not, and maybe just gradually lifting the zero COVID bit by bit, and that won't be enough to stimulate the oil price a lot, in my opinion.
Okay. In India itself, Mark, the big trade in the last 6 months at least was to go short on IT and long on financials, and that worked out very well. You think that could be the order of the next few months too, or could tables turn?
I'm sorry, I better not attempt to answer that question, Sonia, because I haven't been paying enough attention to the sectors in India. Apologize for that.
All right. So, let me just flip that question around, right? I mean, financials globally and in India have done pretty well. And IT, because perhaps of the impending recession in the US, there's some struggles over there. Perhaps client spends could go down. Do you think a lot of that is in the price already? Maybe not for India, but even for the global markets?
I do think that a lot of IT, but certainly not all of it, is what one can call quality growth. And you do have to screen, because companies are all different. But a lot of these companies have, they're leaders in their sectors. They have strong cash flows, and they're good companies. So I would say I would prefer to answer the question by saying that I think whether we're in a bear market, which I don't think we are, I think we're at the tail end of a cyclical bear market, or we're in a structural bear market, which will last longer, I would still want to own quality growth. I think it'll outperform in either environment. In the bear market, in the tail end of the bear market, simply because those companies have derated a lot, they came down more than the market, and in a structural bear market, because I think it means that interest rates will eventually have to come down, and they tend to like that.
All right, Mark, final question before we let you go then. What about India among the emerging market pack? we're pretty happy. We've decoupled from what's going on. We're flattish for the year. But see a market like the Brazilian index, that's outperformed actually in dollar terms. What's the pecking order from this emerging market basket? You know, there's Indonesia in there, India, Brazil. Your take on it?
The emerging markets that have been fairly have uncorrelated economies, and India is one and Indonesia is another, and are kind of proxies for, well, I'll take that back. Anyway, the uncorrelated ones with big domestic populations, India, Brazil, Indonesia, they have outperformed this year. And there is a lot of now speculation that the time is to sell those and shift into the kind of global growth ones that have underperformed, like a Taiwan or a Korea. And I can see both sides of the coin, but I would simply say that our long-term bet is on India. And even if it underperforms, say, a Korea or a Hong Kong over the next 6 months, because they have so much more catch-up to do, because they fell a lot and their currencies fell a lot more this year, the Korean one at least. I would, you know, India is our big bet for 5 years, not just for 6 months, and so we want to stick with it.
Okay, that's, I guess, our headline for the day, right? India is our big bet for the next 5 years and not just the next 6 months. The viewers and investors would be pleased to hear that. Music to our ears. Thanks a lot, Mark, for joining in, and have a great one. That's Mark Matthews of Bank Julius Baer. Let's slip into a quick break on that note. On the other side, our entire research team will be with us and help us with the top 10 stocks. Stay tuned. Welcome back to Bazaar Morning Call. The SGX Nifty is indicating that the start will be well in the green on an adjusted basis. And our own markets as well. Lots of stocks to talk about, so let's get straight down to that. One of the stocks of the day could be Zee, because of the Zee Sony merger receiving the CCI approval. There were, of course, a lot of concerns that the CCI had. Vahishta is here to give us the latest on that. Vahishta, over to you.
Hi, thanks for that, Sonia. Well, Zee and Sony, which were long awaiting an approval for their merger, have finally received the nod from the Competition Commission of India. And this is a big positive because the Competition Commission of India approval is usually considered the largest hurdle and usually takes slightly longer. So CCI had earlier raised concerns on the merged entities' market dominance in TV viewership, on their high fee from advertising, channel pricing, etc. Now, for this, Zee and Sony had made submissions to CCI, and since found satisfactory, the modifications in the proposal have finally been agreed to. The final nod from CCI could probably take another 4 to 6 weeks, and there are also some other pending approvals to be received from the Ministry of Information and Broadcasting. There is also a shareholders meeting which is scheduled on the 14th of October in the next week. There's income tax, there's ROC. Now, while there is a certain reason to cheer, what needs to be carefully watched is that what are the modifications that Zee and Sony will be making, which at present is undisclosed by CCI or Zee and Sony. Currently, Zee stock is trading at an attractive valuation of 15 times its FY24 PE.
All right. Vaishya, thanks very much for that. This is an important one. I mean, it's been so long in the waiting, and I think a lot of you would be wondering if does this bode well for the stock? And it does. Even last week, I mean, right before the expiry, I think it was Thursday, on the expiry day, it had that big 6-7% move from a high of 265, it fell to about 247. And I remember there was a lot of speculation that it's coming, you know, that particular day, and then it finally collapsed. So I think a lot of the weaker hands got shaken out, you know, in terms of pre-positioning for an event like this, I think there is some, because it's been widely anticipated, but not to the extent that we saw last week. So in that sense, I mean, it bodes well for price performance from here. But as Vahishta said, we need to see, are they going to sort of, will they have to shut down a very large popular channel, which is not the base case, but CLSA is also saying is not the base case, or you know, it's going to be smaller regional kind of channels to satisfy the Competition Commission. So that's something we will watch. But this is a big one, long in the making, almost a year now, but has come through now. Bajaj Finance is the other one, which should be in focus. Pre-quarterly updates. Abhishek is here with more. Abhishek.
Well, Prashant, to begin with, the new loans have declined sharply on a sequential basis, while AUM growth, that's perhaps the best in our 11 quarters on a YOY basis. So take a look at the new loans. They are up 7.94% on a YOY basis, but they have declined more than 8% on a sequential basis. The AUM growth, that remained robust, growing at 30.8% YOY and about 7% sequentially. So on a YOY basis, this is the best loan growth that you are seeing in last 11 quarters. Average ticket size, which I've calculated, is up close to 10% YOY and about 2.6% sequentially. Liquidity is at comfortable level given the fact that deposits are also up 15.5% on a sequential basis. Capital was consumed about 110 basis points on a sequential basis, and that is why CRAR, that is capital adequacy ratio, has come down to 25.1% when compared to 26.2% in the previous quarter. Back to you.
All right, thanks a lot for that, Abhishek. Well, let's hop across to Mangalam, Godrej consumer update was a little bit weakish, right?
It was a little weak, It was, reminiscent of what everyone would expect as far as the FMCG sector in the second quarter is concerned itself. Because on the industry, they said the industry continued to remain soft during the quarter. Rural markets witnessed slower growth than, the urban market, and they expect consumption to pick up in the second half itself. This is something that we spoke about in the first quarter as well, that any sort of pickup will happen in the second half itself. Little did the street know that they have to contend with the second quarter as well as we speak. For the company in this quarter, we did see, higher than mid-single digit sales growth at a consolidated level, but margins would actually compress by almost 13 to 15% at an EBITDA level, and that's primarily because of the high-cost inventory that the company has been sitting on, and secondly, upfront marketing investments. As far as India is concerned, there would be a mid-single-digit volume drop, but sales growth would be higher on account of the price hikes that they've taken. And Indonesia, concerns continue out there, double-digit constant currency sales decline. And the only bright part in their overall portfolio is Latin America and Africa. Africa has been showing double-digit growth for almost 8 quarters, and that will continue into the 9th quarter as well. So today's low will be extremely crucial, because for those betting on the second half of this year would be watching the decline in today's trading session.
Okay, thanks a lot for that. Well, let's move on. Abhishek is also tracking RBL Bank and AU Small Finance Bank. How did that one look, Abhishek?
Well, the preview numbers have come in terms of the business momentum in Q2. AU Small Finance Bank has seen a strong business momentum. Deposits up close to 50% YOY and about close to 7% sequentially. The loan growth is pretty robust at 41.6% YOY and 8% sequentially. CASA ratio might be at all-time high of 42% when compared to 39% in the previous quarter. Their collection efficiency in the month of September has improved to 109% when compared to 106% in the previous month, as well as the 106% that you saw in the month of June. So RBL Bank, there is a mixed bag, especially in terms of deposit momentum, but loan growth has picked up, which augurs well for the bank. So deposits are up only 5% YOY and almost flat on a sequential basis. CASA ratio, or the low-cost deposit ratio, that might be at an all-time high of 36.2%, and loan growth pretty robust this time around, coming in at 11.6% YOY and about 4.2% sequentially. Back to you.
All right, thanks a lot for that. I'm also watching out for some of the aviation stocks, and here's why. The government has gone ahead and increased the credit limit for the aviation sector under the ECLGS scheme, which is the Emergency Credit Line Guarantee Scheme. Now, the loan limit for the aviation sector particularly has been increased to 1,500 crores from 400 crores earlier. And we all know that many of these balance sheets are extremely stressed, and fund infusion is the need of the hour. Now, the government intends to give collateral-free liquidity at reasonable interest rates to tide over the present cash flow problems. And SpiceJet sources have told CNBC-TV18 that they will receive an additional 1,000 crores as part of the enhanced ECLGS scheme. Now, SpiceJet is in urgent need of funds, and there's no recapitalization plan in place. If you look at the company's balance sheet as well, or the P&L rather, it's been losses galore. The last 4 years, losses have gone all the way to 1,700 crores. So I'm going with green there, because at least they'll get some more funds now on board. Indigo as well, Credit Suisse recently came out with a report, in fact, this morning, with an outperform rating and a target at 2350. They also say that now crude has peaked and currency risks are now behind us. So the other merits will surface, like an improvement in travel, etc. So going with green over there.
Okay, all right. Sonia, so we'll keep an eye on both those two stocks. Vivek joins in to tell us about IEX. Vivek, the monthly update disappointing yet again?
Well, that's right. Couple of factors leading as far as IEX is concerned. But, importantly, the company gave the operational update for September 2022. And the volumes, the company managed to achieve a volume of close to 8,160 million units. Now, these volumes on a year-on-year basis were muted, down almost 8%. Monthly, there has been a sequential uptick, up almost 5%. Now, interestingly, what has actually happened is that the company has said that the average clearing price in the day-ahead market has risen quite significantly to 5.63, and this is up almost 9% on a month-on-month basis and also up 28% on a year-on-year basis. This is on the back of the fact that the company has said that supply-side issues are what is actually causing the uptick as far as the price is concerned. They're also saying that the high prices of e-auction coal, imported coal, as well as gas has actually kept some of the sellers away.
All right, Vivek, thank you very much for that. IEX in focus now. The other big story for global markets in India specifically, right? I mean, we can talk about equity flows, decoupling, not, etc., but there's no decoupling from oil. And oil is moving higher steadily but surely. Manisha is here with more. Manisha, good morning.
Oh, absolutely. Thank you for that, Prashant. It's quite toxic the way you look at it right now, with the crude oil prices now back above $90 per barrel. Inflation concerns still on. The rate hikes could be aggressive yet again, is what the dollar move tells us. And then the kind of slowdown that you're looking at, crude does not help at all. But the OPEC and allies do believe that cutting output is the only way. And we've seen the higher end of the number come at 2 million barrels per day of a cut. That is what we will see from the month of November. That's 2% of the global supply, and the OPEC will now hold the next meeting only on 4th of December to assess the situation yet again. As of now, this is the biggest output cut that we've seen since the start of pandemic, and quite a reversal from what they had done in the beginning of 2020 when they had started cutting output at record levels there. What the markets will watch out now is, one, the next OPEC meeting. Second is the U.S. non-farm payroll data. Third is on what Russia does in response to the U.S.-led plan of a price cap. That is also coming in the first week of December. Markets do believe that we are now looking at a higher side of the range. 85, 88 could be near-time support. On the higher side, 95 to 98 is what the markets are citing now.
Okay, thanks a lot for that. So let's do a quick recap then in case you missed out on any of the stocks. Stocks with positive news flow today, there's Zee Entertainment, there's Bajaj Finance, there's RBL Bank, AU Small Finance, Interglobe Aviation, SpiceJet, ONGC and Oil India, while stocks with negative news flow, there's Godrej Consumer and IEX.
Well, time to slip into a short break. Up next, we'll connect with Anand Tandon, market expert, for some fundamental stock analysis. Later on, we'll also be joined by Raj Nayak of House of Cheer Networks and Karan Tarani of Elara Securities to discuss CCI's approval to the Zee Sony merger. More on that on the other side. Stay with us. Well, we're coming back from a midweek holiday, so good to see the SGX if we're suggesting that we like to see a big gap up. You need to compare that with the Nifty futures, so it'll be roughly around 130 points gap up that we're likely to see in the next 45 minutes when we open up. But to discuss a few stocks, well, we're joined by Anand Tandon. Morning, Anand. Thanks so much for joining in. Well, we'll be discussing Zee in greater detail, so I'll put that aside for now. Let's talk about Bajaj Finance. They came up with their quarterly update. It looked pretty good because the AUM growth was out there. However, the number of loans that declined. Now, CLSA, they are saying that if this growth is going to be led by higher ticket loans, that could be under pressure in case things go wrong and there is a slowdown. What's your view on the stock? Valuation-wise, has always been expensive.
Right, so we'll leave the valuation aside. Basically, it is now being viewed more and more as a credit card company in the hope that they will be able to launch their credit card. But otherwise, if you look at credit growth generally, and you can see that from the bank, that is certainly an area that has been growing. Of course, most of the banks have been doing it for lending to corporates, whereas this is a consumer lending. But even if you look at SBI, for example, SBI credit cards, they also are showing fairly robust growth. And at the moment, the thesis that you are operating under is that the domestic consumption growth, at least at the higher income end, is the one likely to move up. So while there could be an argument to be made that the higher ticket will reduce the size, the reality is that is where the growth is likely to come in, because you are looking at the higher income group relatively in India trying to pick up credit and expand houses, increase the consumer durables and so on. So I don't think that is so much a strategic worry to me, because if the loan size were to come down, I'm sure Bajaj will also adapt. From a corporate perspective, they've been doing most of the right things. So, if you're comfortable with the valuation, it remains a core holding.
Okay, if you're comfortable with the valuations. We're going to, of course, talk in greater detail about this whole Zee Sony merger, getting the CCI approval. But what are your thoughts? You know, now this merged entity has, what, 24% share. It's higher than Star at 20%. And there's so many benefits, right? Cost optimization, bringing down employee costs, etc. Do you think the best is already in the price, Anand, or is there more to go?
Well, I think there is more to go if they manage it well. There is always a problem when you're trying to put two companies together. But the interesting thing this time is that the Zee promoters have a very small stake in the company. One of the risks that was always there and that we have seen in the past in Zee has been that there has been a sudden increase in production costs. And if that were to happen, that can take away some of the sheen. But I'm assuming that, with Sony also watching carefully, you cannot have a sudden unexplained increase in production costs. And that will mean that, as you mentioned, the size, the bouquet of products that they have, Zee is stronger in the regional, Sony is stronger in the, in the main languages and so on. So put together, they will be able to offer advertisers a very strong bouquet and therefore should be able to increase their market share if things go well.
Okay, in fact, let's take this discussion forward. We have two guests joining in. As we told you, the Competition Commission of India has now approved the Zee Sony merger after companies allay concerns over market dominance, higher advertising fee and channel pricing mechanisms. The merger is now pending approval from the INB Ministry, shareholders and the Income Tax Department, but it seems likely that it will come through. To discuss this latest development, we are joined by Raj Naik, the founder at the House of Chia Networks, and Karan Taurani, the Senior Vice President, Research Analyst at Elara Securities. Gentlemen, morning to both of you. Raj, good morning. Thanks for being with us on CNBC-TV18. Pleasure speaking with you after a while. You know, this is big, right? I mean, the merged entity is now going to have more share than Star. They're going to have several synergies, including bringing down costs in a big way. What do you see as the way forward?
Good morning, Sonia, and nice to see you again. I think it's a good thing that has happened because the television industry was going through a little bit of a turmoil, and this whole merger, I think, there will be a very strong entity, and I think they complement each other in many which ways. But, we all keep harping about they're going to be X percentage higher than X, Y, and Z. But the way to look at it is now there will be three strong entities in the overall national space, that is Viacom, Disney Star, and Zee Sony. And also don't forget that even in the regional space, there is strong competition from individual players, smaller networks as well. So I think what will happen now is the way to look at it is there will be three strong competitors in the national space. And of course, they will have to fight regional players in the regional space as well.
Right. Raj, hi. Karan, hi. Good morning. Karan, specifically with regards to this deal, satisfying certain conditions, there is some fear that they may have to close down one of the sort of prominent channels. There was a news report to that effect as well, although that is not the base case. How should one think about that? Will something of that sort have significant revenue implications, or you think it'll be one of the smaller ones? Your sense?
So I think if you look at press release issued by Zee on the 4th of October, there's clearly mentioned over there that both the parties have submitted a voluntary remedy to CCI in terms of which channels to switch off and how will they actually move ahead with the deal. I mean, we don't know in terms of what the voluntary remedy is. Is it on ad pricing? Is it on bargaining power? Is it on channel switching off, or which channel switching off? But if one can try and assess the word voluntary, it clearly indicates that there is a very low likelihood of a large flagship channel switching off. I think that is like a very huge overhang that one thought that maybe a Sony Entertainment Television or a Zee TV can switch off. So that was like an overhang which was there. But we are hoping that that is not the case. And if that is not the case, I think all is well for Zee Sony merger. And the reason why we are saying that there's very low likelihood of this event happening is clearly because of the viewership share. So if you look at the viewership share of the combined entity in terms of the Hindi, GC, urban, rural, everything put together, it is somewhere below 40-odd%. And then that makes it like a low likelihood event that some of the large channels might switch off. But nonetheless, I think there is always a likelihood of some small channel possibly going off air. For example, Zee in Marathi is very strong. Sony is very poor over there. So you might have Sony channels switching off over there. This is very hypothetical, but just something that could happen in our view, basically.
Hi, Karan. Morning. Hi, Raj. Morning as well. Well, Karan, just want to probe you a little bit. So you're saying that one of the flagship channels are unlikely to get shut down, which will be good news. But, there is also some synergy benefits that people are talking about. So you must be having a pro forma number right now in terms of margins. What kind of an improvement can come about, say, in the next couple of years? And also, what kind of a multiple are you giving it? It's supposed to be a re-rating event, right? So what was it? What are you likely to give it now?
So firstly, we valued Zee Sony on an SOTP basis. And if you look at the synergies, there are various assumptions into it. There could be revenue synergies wherein, they could have a better hold in terms of pricing because of the entity being so large and controlling such a large part of the viewership share. There could also be another revenue synergy, which would be in your distribution market share, where, they could probably have a higher share versus the distributor, which is your MSO and DTH. And there are also a lot of cost synergies which are there. Now, cost synergies could be in the form of, content cost, basically rationalization of content cost, employee cost, marketing expenses. So broadly, I think synergies on revenue are in the range of 5 to 6%. Synergies on cost, again, could have a positive impact on overall, PAT by almost 15 to 20%. So there is a big amount of synergy sitting out there for the merged entity. But what we have assumed in our estimate for now is the cost synergy part, where, we are expecting the overall cost base of the company put together today to come down by anywhere close to 5 to 6%, possibly, because of marketing expense, employee, and the content cost, which is there, which kind of will get rationalized from here on. So that's the synergy that we expect. In terms of valuation multiples, typically, the broadcasting business has been struggling in the last 3 to 4 years since we have seen, 4G, OTT coming in. The digital has really kind of had a huge negative impact in terms of incremental growth, viewership, and eyeballs number for the TV segment. And basis that, I think the valuation multiples for the broadcasting business have converged in the range of 12 to 15 times, for the industry, basis where they stand. Now, because of this merger, because of the entity becoming so large, because of, them possibly having synergies, because of them being able to create a large OTT platform. And one can't forget the fact that, IPL, Disney has actually lost IPL. So that will kind of get them on par with Zee Sony if both these platforms come together. So there is a lot to happen in terms of performance, execution, content, strategy. And basis that for the broadcasting piece, we are expecting a multiple of close to 19 to 20 times forward for the combined entity.
Okay, what's your target price on Zee Entertainment?
So our target price on Zee Entertainment is 425 rupees.
Okay, that's a big upside to where the stock is currently. Raj, I wanted you to come in on this pricing, right? Both in terms of ad rates and channel pricing. Generally, when two large entities come together and there's a merger of this sort, is there a major change in ad rates and in channel pricing in general?
Yeah, I think obviously there are huge synergies and huge benefits like Karan mentioned. But the way to look at ad rates is, again, I don't think you should look at it as like a monopolistic situation for two reasons. End of the day, you will have to compete with the marketplace, right? So it's not that you can just, because you come together, you can just go and raise your prices. That's not going to happen. But what is good is I think they will have a lot of savings on costs in a big way. And of course, they will be able to leverage the strength of, because they complement each other in many ways. Like Karan mentioned, Sony has sports, Zee doesn't have sports, Zee has are strong in the regional space. So the way to look at it is they will complement each other. There will be a lot of savings, and I would put the same figure. There is an upside, overall upside of about 20-25% in my opinion. But again, not to look at it from an advertising that you will be able to come and take the price up. That's not the way to look at it. The way to look at it is as a joint entity, they will be able to leverage their products better in the marketplace.
Karan, how much does Oppenheimer own now? 10%?
Yes, it's around that much.
Okay. And would you expect any movement in that shareholding anytime soon? I mean, there is some talk that they were waiting for this approval and they may want to get out, and maybe Sony buys that up as well. Any thoughts at all?
Yeah, I mean, that could happen, but we don't see any issue in the shareholder approval meeting, which is going to happen on the 14th of October. I think that should probably go through, and then post that, there may be some kind of exchange in terms of the shareholding.
All right, fair enough. We'll leave it there. Thank you very much, Karan and Raj. Appreciate both of you coming on this morning with your perspective. Very useful discussion in terms of this big approval from CCI with regards to Zee Sony, finally coming through almost after a year. Anand Tandon, of course, is still with us. Anand, thanks for waiting. So you did talk about Bajaj Finance, right? But it's not just Bajaj Finance, Anand. There is, you just look at Tuesday's session, IDFC First Bank, Mahindra and Mahindra Finance, IndusInd Bank. I mean, there was a RBL Bank, the 5, 6, 7, 8% moves across the board. Out of this entire banking financial services space, what do you like best, Anand?
So, we've been talking about this for a while now. I think I've been arguing for the fact that the credit growth will be picking up and therefore you should be looking at banking, because as the interest rate firm up, their ability to pass on that increase is fairly strong for the moment and the balance sheets are fairly good. Now, what has happened is that obviously the spread between the credit growth and the deposit growth has become fairly large, and the deposit growths are still slowing down, are still not growing fast enough to be able to keep up with the kind of credit growth that we have begun to witness. So while the initial phase, pretty much the tide will lift all boats, and that's what we are seeing, we have now got to a stage where I think within the next few months, you'll have to look at those which have the highest franchise for being able to pick up deposits. So, so far the ability was to be able to lend, and therefore you were looking at the corporate-facing banks, because that is the place where the larger banks benefit the most. Now you have to add to that the fact that they should be able to pick up deposits, otherwise they will find a strain in terms of credit growth. And this brings you to focus back on the leading private sector banks. So I would argue that, this is now a time for looking at, of course, continuing to be looking at the top corporate banks from the public sector, but adding to that now the traditional good old private sector banks, which so far had been leading the rally for the last several years, but have been taking a bit of a rest right now. So rather than looking at many of the smaller banks, which will have to pick up the deposit rates faster, I would still think that you are better off looking at a Kotak, HDFC, ICICI kind of Axis kind of play, because that is where you'll have the best of both worlds.
Right. Well, by the way, Macrotech developers just came out with their update looking cracker, best ever quarterly sales for the company. And their debt has gone down quite a bit compared to what they had last year as well. So that'll be one of the stocks in focus. It's had a pretty stellar run. We'll talk more about that.
That's a Mumbai player, right?
Yeah.
I mean, it almost blows my mind to think with real estate prices where they are in Mumbai, sales continue to do very well. Someone was saying that September has grown 1% month on month over the previous month, August. Wow. Which is, and August was a record, so September is a new record.
I mean, even these numbers, 60% year-on-year growth in pre-sales, right? Yeah. People are definitely upgrading, buying more homes. I mean, you can see that there is this gap between the rich and the poor that's sort of widening. Yeah. Okay, well, we'll talk about that in greater detail. Let's slip into a quick break. On the other side of the break, Sudarshan Sukhani and Shrikant Chauhan will be joining in for some technical trades. Stay tuned. Well, it's green on the screen this morning, so let's get our technical gurus to tell us how to approach the morning trade. Sudarshan Sukhani and Shrikant Chauhan are joining in. Sudarshan, good morning. After a couple of bad days now, we've seen some stability across global markets. Do you reckon the Nifty could resume its uptrend? And if yes, what are the levels that you're looking at?
Good morning, Sonia. See, the Nifty is in an uptrend, but only problem is it's doing that with big, large opening gaps. So for the short-term trader, it becomes very difficult to catch it. I would think that the first resistance for this up move in the Nifty comes somewhere around 17,500. And it's not an exact number always. It could be a little more also. So assuming the Nifty opens around 17,400, on any minor or small dip, there is still a buying opportunity. I would expect the 17,500 plus number to be touched sooner or later, today, tomorrow, Monday. So the trade in the Nifty, I can't say whether it's resumed its uptrend, but I can say that we should still be long in the index and try to be, because of the gap up, try to be long on minor intraday dips or consolidation and if possible carry the trade. The same applies to the Bank Nifty. The Bank Nifty has outperformed again after a few days of sort of sideways move. That's a much better trade. Go long in the Bank Nifty and wait patiently.
Okay, all right, got that. Sudarshan. Hi, Shrikant. Morning. Coming across to you. How would you trade the index?
Good morning, Nigel. I think, see, like Nifty has very clearly broken the level of 17,200 with the broad-based participation. And maybe because of that, we are going to see further more upward activity. And as Mr. Sudarshan said, yes, if there is any correction, we should be buyer in the market. We are expecting market to hit the levels of at least 17,450, 470, and maybe in the best case scenario, 17,700. So that's the overall view. So the strategy should be to look for buying on dips. And for the Bank Nifty, 38,800 is going to act as very good support. On the higher side, 39,700, 750 seems achievable.
Okay, let's talk about individual stocks then. Sudarshan, what would be on your buy and sell list this morning?
Well, this is a buy list today. It does appear that the markets, at least the Indian markets, could do something good. So Adani Ports is a buy. It's gone through a very deep correction, almost a mini bear market. I think this is a buy on dips opportunity because a lot of stocks have already flown away. This one may be willing to rally. Buy with a stop under 804. Coforge is a buy. Same story, big correction, now sideways move. Perhaps this is another buy on dips opportunity. Buy with a stop under 3,400. ICICI Prudential is more of a high risk buying opportunity because it's not given us clear signs of bottoming out. But in this uptrend and bull markets, anything can happen. Buy with a tight stop under 515. And finally, Polycab did not correct even when the Nifty was correcting. It's an outperformer. So buy Polycab with a stop under 2590. As usual, watch the markets carefully and manage your risk.
Right, buy strength, buy relative strength. Sudarshan, thanks for that. Srikanth, what about you? What are the trades?
Yeah, Prashant, I think two stocks are doing really well. IRCTC, which is around 720, 719, it is forming some symmetrical triangle sort of formation. It's a continuation formation. So based on that, we are expecting stock to move towards 750, 760 sort of levels, which is decent upside from current level. So IRCTC is a buy at current levels with a stop loss at 707 on the downside. And the other stock which we like is Reliance Industries. We are expecting upward activity in the market. So I think it should get backed by Reliance Industries. And it is also forming some higher top, higher bottom formation on intraday basis. So again, here also we have a buy call with a stop loss at 2370. We are expecting stock to move towards 2500 in the near term.
All right, thanks a lot for that, Srikanth, as well as Sudarshan. Let's slip into a quick break. We'll have the pre-opening rates kicking in. We'll also have Anthony Cherukara of VST Tillers and Tractors to talk about their tractor sales for the month of September. Do stay tuned in.